Hello, friends. We are back again today with another episode of our 5 bucket saving strategy. And today we're going to be taking a deeper dive on how to manage risk. So, what is risk? Let's start off with that. This is a very broad topic, but essentially, risk is exposure to something that is dangerous or harmful. So, causes harm. And in today's lesson, it's specifically going to focus on financial risk. So this is not an extremely sexy topic to talk about. It's often breezed over by a lot of people who are planning for their financial success, but I promise you that it is an extremely important, really cornerstone of your financial plan to consider implementing or at least learning more about. So let's keep it nice and simple. We're going to do kind of a bird's eye view of risk management today. So there's two major types of risks that you can take. The first one is investment risk. And the next is, we'll call it lifestyle. Now, when it comes to investment risks, we're going to just breeze over this because this is covered more in the wealth management bucket, but I want to be clear that all investments have a component of risk associated with them. So some common ones would be market risk, inflation risk, interest rate risk, business risk, credit risk, and taxes. So real quick, market risk would be volatility. So the ups and downs in the market, you're not guaranteed to make money. So putting your money into the stock market, you have potential of losing principal. This is a risk. Inflation, we've covered this in the cash management bucket, but this is the rising cost of goods. Your money, if it's sitting in a bank account, is becoming less and less valuable. This is a risk that we are facing on a daily basis. Interest rate risks refer to current prevailing rates. When rates go up, it's more expensive for you to borrow money. It has an impact on the overall economy, and vice versa. When rates go down, it becomes less expensive for you to borrow money and has an overall effect on the economy. Business risk is essentially the probability of a specific business that you're investing in to go out of business. So a good example would be like Blockbuster versus Netflix. Blockbuster eventually or almost went out of business. So if you were invested in Blockbuster, you lost a lot of money. Next is credit risk. So this is the likelihood that an entity or institution is going to be able to pay you back. So let's say you purchase a bond and that bond issuer defaults. They're not able to pay you the interest and the principal that you lent them. This would be considered some type of investment risk specifically related to credit and the ability to make good on the loans. Last but not least is everybody's favorite one is taxes, because we all have to pay taxes, and depending on legislation and type of income, you're going to pay a different amount of taxes. And when people are taking money out of your cash flow, I would consider this a risk. So quickly wanted to go over the investment risks, but again, this is covered in the wealth management bucket. And we do this through diversification and asset allocation, just to name a few. Next, moving over to lifestyle risks. Lifestyle risks are going to be a little bit more personal. Some to consider would be life, disability, health, long-term care, and umbrella. Now, life refers to life insurance. So unfortunately, at one point or another, we are all going to pass away. And when we pass away, we are going to leave potentially, financial burdens, or we would like to leave financial resources to the people that we care most about. Maybe it's our spouse, maybe it's our children, maybe it's a charity of your choice. But as you are alive, you are providing value to the economy, you're serving the people around you, and most likely you're being paid for it in some capacity. When you pass away, you no longer have the ability to earn income. Therefore, the people who are relying on your ability to earn income could be left in some type of financial hardship. So life insurance will help make sure that you are leaving financial resources behind at the end of life that is able to help whoever you care most about. Next is disability insurance. Disability insurance, similar to life insurance, is going to help protect you while you are working, but disability insurance actually just replaces income. So if you're the major breadwinner and your family and spouse are relying on you to earn a living to make sure that they can put food on the table and clothes on their back and a roof over their head, and something happens to not only your life but your ability to earn an income, then your family is going to, again, be faced with some financial hardships. So disability insurance helps replace, if you are no longer able to work due to some type of medical disability, it will help replace the income that you were generating. Next is your health insurance. Health insurance is going to help take care of any type of major medical expenses. Now, this is a big one because a major medical expense can be one of the biggest things that derails a family's financial plan. Imagine having to go in for surgery or getting cancer. Like my father just got put in the hospital for some type of gastrointestinal issues. And if he didn't have the necessary coverage to, pay for the medical bills, and he needed to come out of pocket with that money, it could have a massive impact on his overall financial freedom and his ability to sustain the lifestyle that he's developed for himself. So making sure that you have the right type of health insurance to cover any type of major medical expenses is a really important factor in your overall financial plan, and currently is one of the things that is legally mandated to have. Next is long-term care coverage. Long-term care coverage is specifically going to help fill the need in the case of a long-term event. So a long-term event can be summed up into the inability to perform 2 out of the 6 daily living functions. So these are things that include being able to move yourself around, being able to toilet yourself, being able to clothe yourself, being able to feed yourself, having cognitive thoughts, to name a few. So if you're unable to do these things, you're not able to take care of yourself, you can't perform 2 out of the 6 daily living functions, and you have a long-term care policy, this long-term care policy can help you pay for the difference, or help you pay for things like home health care or nursing or some type of need that you're going to have. Like it could even help you, install a wheelchair that brings you, a wheelchair ramp that helps you access your house if you become disabled to the point you no longer can walk. Next, we have umbrella insurance, which essentially is going to be a liability policy that kicks in after all the other liabilities clauses in your other insurance policies have been fully tapped out. So let's say you have an auto policy and you have a liability coverage on your auto policy, but you get in an accident and your accident constitutes a bigger amount of liability that you need to pay that goes above and beyond what your auto insurance policy covers you for. An umbrella policy will start to fill the gap. Again, auto is something that is actually legally required. And then last but not least, I would like to add property insurance. So this is things like homeowners insurance or renters insurance that protects your actual physical property if something was to happen. Now, when it comes to managing risk, there are 4 major risk management strategies that you can deploy to help you either avoid or reduce or transfer the risks that you are taking. So for risk management strategies would be reduce, retain, avoid, or transfer. Let's talk about this in a little bit of an example. So let's say you're gonna drive to the supermarket in your car. If you want to reduce the risk that you're taking, you might put on a seatbelt, right? If you want to retain the risk that you're taking, you may drive at 1,000,000 miles an hour, not wear a seatbelt, swerve in between all the lanes, and actually increase the risk that you're taking. But you really choose to not mitigate it. You still need to get to the store. So there's some level of risk that you're going to retain, but then there's ways that you can help reduce it by putting on a seatbelt or driving the speed limit, using your turn signals. The other option would be to completely avoid it altogether. This would be just don't go to the store. Maybe you order Grubhub or you order Uber Eats and they deliver you the food for you. And the next would be to transfer it. So this would be like having an auto insurance policy or having an umbrella policy. So if something does happen, an accident does happen on the way to the store, that you are able to put that burden of paying for that liability on somebody else. Now, generally and kind of overall, risk management is something that is extremely personal, right? Everybody's, again, going to have different needs, and each one of these policies and specific types of risk management strategies has a lot of underlying details. So it makes a lot of sense to get with a insurance professional, whether you're looking to get life insurance or disability insurance, or maybe you need to take a look at your homeowner's insurance, making sure that your auto policies, appropriate for the type of vehicle you're driving. There's going to be industry professionals that are specifically know specifics about that policy and that can help point you in the right direction and teach you the things that you need to know to help protect yourself from the greatest risks that you're facing. So this is a broad overview, guys. Risk management is a massive subject and it can go on and on and on, but I wanted to give you the really starting point of how to consider the risks that you're taking in your life, because everybody's different. Again, I can't stress this enough in almost all aspects of financial planning, but you can see it when you look at your friends. You have the friend who likes to go skydiving, cliff jumping, and travels the world and makes no plans and drives extra fast and just naturally is okay taking on more risk. And then you have the friend who's a little bit more conservative, needs a plan, always drives the speed limit, puts a seatbelt on, is a lot more conservative in their overall life. And just that drastic difference between two different personality types really does a good job of illustrating the different variances that you're going to have when dealing with the risk that you're trying to mitigate in your specific situation and in your life. So with that, you guys, I hope this gives you a little bit more insight into what risk management actually means, especially from a financial planning and, finance standpoint. Please let me know what you guys think. If you want to know more about any one of these specific policies or types of risks, and again, different ways to avoid the risks that we do have to face on a daily basis, because life is full of them and they are unavoidable. So with that, hopefully everybody has a wonderful day, faces no major, risks that are unavoidable, and can go off and prosper. Take care.